I think the stock market's been really resilient this year because in the face of what is very scary macro developments, curve developments, political risk, we've hovered near highs and actually, up almost 20% year to date. Going into the final 10 weeks, there's a lot of favorable factors. I mean, we've got seasonals. We normally get a Santa Claus rally. There's a ton of cash on the sidelines. We saw that with the Merrill Lynch survey, record cash positions and big underweights in equities. And I think economic momentum is actually going to start turning. So I think that's the message coming out of 3Q earnings, and I think that's why cyclicals are rallying. And a turn in economic momentum is going to be a risk-on scenario.
Okay, let's debate this as a desk, okay? It's a bullish call. The market, by and large, has not done much in 18 months. I said we're about 1% away on the S&P from a new high. Why is Tom Lee going to be right? It's not about the call itself. It's about why it's going to be right or wrong.
There's one reason that you're going to be right, and I hope you are right, and it's because the trajectory on the China-U.S. trade front has turned positive over the last week. However, Tom, if you don't have that continue, you'll be wrong. Sorry, you just will. I hear you on the bottoming of leading economic indicators on ISM surveys across the world, possibly bottomed, but they won't bottom unless you get that continuation of what started last Friday. Now, let me be clear about one thing. Continuation does not mean a straight path forward. It will be 2 steps forward, 1 step back. But that net 1 step forward is what matters.
What happens if the Fed is not as accommodative as the market seems to think it's going to be? You could make, I think, a credible case to this point, whether it's our own Steve Leisman's reporting that suggests a pause is coming, whether it's in October or after. Some of the Fed speak goes along the lines of rates are in a good place. The economy doesn't need a rate cut. Clarida today moving maybe a little more towards neutral from dovish. That's not necessarily a scenario that the market would take kindly to. In fact, the market looked like it gave a little bit up on those breaking headlines from Leisman.
Yeah. There's a lot of risk to I think Jim's dead right, the trade issue. And the Fed last year was a big problem for markets. I think the difference is I think the Fed is paying more attention to market signals. The curve is still messed up, so I think it's necessary to see some further easing. But you're right. If the Fed pauses, it's going to raise some questions. And then, we have 10 weeks to work with. Last year, December was a bad time for a policy error, and it destroyed a lot of years.
So, Shannon, give people the read on what are we supposed to do for those last 10 weeks?
Well, I think, there is evidence that if you look out over the course of the next year or so, one of the things that we need to be looking at as part of the earnings season is what are multiples doing? So, as much as, you can get some gains in bottom line EPS growth into a stock price, it's really about the multiples. And so if we feel like there is evidence that we're starting to see a bottoming in some of this economic data and that's trending towards positive multiple expansion, then, that's something that we can be buoyed by against a backdrop of uncertainty around trade and against a backdrop of the Fed. I mean, I think that's why this earnings season is so important, despite the fact that we obviously have seen a deceleration in earnings growth. This multiple expansion is really what we need to be looking for.
Earnings thus far have been pretty good. RBC today says the valuation problem with the S&P has gotten worse. They say Citi does. The concerns are piling up, and they point to sentiment. And kind of Tom Lee said there's a lot of money on the sideline. Mm-hmm. It's not necessarily, you're going to wake up one morning and that money, Rob's going to find its way into the market. Sentiment is somewhat negative.
But it is.
Is Tom Lee right?
He is, and what he outlines
You're bullish too?
No, we're underweight equities in the very short run because we think these headline risks are going to dominate, whether it be the Fed, more importantly, trade, some of the things that Jim said. But that's the base case. I think the upside case, the one that can be made, is that positioning is way off sides, okay? And in this growth and inflation paradigm, if you have, which is pretty positive, you have low inflation, it's the disinflationary forces of technology that have gotten us here. I think it's structural. And in this type of environment, you can have higher multiples. There's no question that historically we've traded at 20 times. So what gets investors and hedge funds last month, I think you may have seen this performance statistic, they were up 50 basis points. The S&P was up 1.7%. They are clearly underinvested. If you look anecdotally across our client base, we are clearly underinvested. All pullbacks have been shallow. Modestly good news has been met with buying.
Why are you underweight? Why are you underweight US equities then?
So I think that the political motivation to get a deal is not present currently. It may be present soon, but it's not present currently. And I do think that the market's a little offsides as it relates to the Fed. The market is definitely pricing in a Fed cut. You had Sternlick on here this morning talking about everybody, the smart money that talks about this, I think acknowledges we don't need to cut absent the market pressure. You're pushing on a string almost at that point. So you're reacting to what's happening abroad.
When did you move to underweight U.S. equities?
Week ago.
Okay.
Week
so
and a half
very
ago.
near call.
Very near
recent call. Debate. Far sides of the table. Underweight U.S. equities, overweight
in the short run.
U.S. equities.
In the
What's
short
the short run? I mean,
short run is the intermediate term.
20 minutes.
6 months.
And get bullish.
Think
6 months.
Actually 3 months. Next year, I think first quarter, we're going to start to see
but this
some
year's
positive
shot. The
development.
rest of this year is shot.
We think we are basically where we're going to be at year end, and the upside opportunity is not near as significant as the downside risk at 17 times.